InvestaCrowd. InvestaCrowd is an online capital marketplace unlocking real estate investments for all. Today, we're very pleased to welcome Kevin Said with the AUS Financial Group. Kevin is visiting us here in Singapore, so extra special treat for us. Kevin's going to discuss a current live mezzanine debt offer in Melbourne, and I'll just let him take it away. There you go, Kevin.
Thanks, William, and welcome to InvestaCrowd, investors, and thank you, InvestaCrowd, for this opportunity to present today the opportunity that we have for a mezz finance transaction in Melbourne. Okay, so first I'll just do an introduction of AUS Finance Group. We're a finance company based in Melbourne, Australia. We have been running a finance company for 12 years and a private equity business for the last 4 years. We specialise in providing private equity and investment specifically into property developments in Melbourne, mostly Melbourne, and residential properties. We work with a very small team of developers, and we have a core group of around 100 investors. We manage approximately $30–35 million of mezzanine equity, which supports about $200–240 million of property development. My background is I've spent 21 years with Citibank and ANZ and Deloitte between Melbourne, Sydney and Singapore, and mostly in the retail wealth, risk and compliance governance space. Right. In terms of again, just as some background and context, our investment strategy is pretty much predicated on very much a strong risk culture and approach to all our investments. We typically do 5 or 6 developments or investments a year, so we spend a lot of time preparing and sorting out which investments we want to be part of. And we've got a pretty strict criteria in terms of those investments that we will participate in. And I can talk about that criteria a bit later. But primarily, we're very interested in there's good opportunities in this mezzanine space. There's good return. We work very hard to make sure that our position is secure, that we understand all the various aspects of the transaction, and then we invest in it. AUS Finance Group itself is also an investor. We invest in all the programs ourselves and stand side by side with the investors. I talk about our risk culture a lot. It's probably a characteristic of our business model, and it's something that certainly the investors are always interested to hear more about, because it's great to get the good returns, but understanding the risk is probably the most fundamental aspect of any investor considerations when they're going into these types of investments. And not understanding the risk is a risk in itself. So we're pretty focused on exit, and when we finally decide to go with a particular investment, we spend a lot of time making sure that our exit positions are secure and that we can, if need be, reverse our position and take the investors' money back out and secure that. I'll talk a little bit more about that a bit later. Okay, the next slide, investor entry points. Again, just some context for the investor to understand how they can get involved in these types of developments. So what you see there is a typical capital stack representing the 3 layers of funding for a development. At the bottom, you have the bank, who typically provides up to 70%. At the top, you have the sponsor or the borrower providing 10%. And we sit there in the middle, typically around 20%, between 15 and 25%, providing that mezzanine component sitting between the sponsor and the bank. That contribution to equity can take the form of a debt instrument, or it can take the form of an equity instrument. And it can be hybrids between the two. Typically, we focus more on the equity type instruments. They just give us an opportunity to secure our position in the transaction better. Typically, with the equity investments, we have 2 types. We have a direct equity product, and we have an indirect equity product. The direct equity product, as the name suggests, is simply an opportunity for the investors to buy units in the actual property-owned entity. So they have a direct ownership of the property. Still within a syndicate structure, within the trust, that we as the trustees manage, but they have a direct ownership. Indirect is where they will buy units in a trust that we manage also, and that trust then buys or invests in a share or lends money to. So that's typically the structures that we're looking at. Okay. The next slide, again, context before we get into the actual investment. This is a typical project life cycle for a development, which I'm sure many of you are familiar with, but it covers 5 phases, which if you look at to the left of the screen, you see the due diligence phase in the light grey, then it moves to the design phase, then moves to the permit application phase, excuse me, the pre-development phase, and then the construction phase. Each of those activities take a period of time, so we get involved right at the beginning at the due diligence phase, and we look at seriously probably about 20 to 25 transactions, and of those 20 to 25, we would do maybe 2 or 3 over a 6 to 12 month period. So there's a lot of sifting out of transactions. To actually get to that short list of 25, we look at probably 3 times that number. So once we go through a due diligence process, which is a series of tests that we do in terms of the metrics, in terms of the developer, their background, the design, does it fit the market, the market risks. We also test the bank's appetite to participate as a debt provider. And we follow all those through. We look at the risks around the permits, etc. So we go through a pretty detailed screening process in the due diligence before we actually commit investors' funds to a project. During the due diligence phase, Oz Finance funds all the expenses or the investment in the due diligence. Once we get to the first phase for a deposit, I put a syndicate together and we fund the deposit, which is typically akin to a bridging finance facility for the developer until they have their own cash to put to refinance us out. And then we move through each of those black dots that you see running along the curve. Points are milestone points where we raise additional capital, and that's the opportunity also for investors to exit. If they come in at one particular point and they want to exit at the next point, they can exit at that point and they'll be taken over by another investor. And we add capital as we go through the project because the project requires more capital as you go through. Today, the investment we're talking about with Investor Crowd is right at that last dot point where I've written proposed investment. So we've completed the due diligence, design phase, permit application, pre-development phase, and we're already into construction. So the project has actually been in construction for 3 or 4 months, and I'll touch on that a bit later. So it's coming in at the tail end of the project, which means that it's obviously a lower interest rate, which is around 20%, 19.56% per annum. But it's correspondingly, it's been significantly de-risked in terms of qualified pre-sale debt hurdle has been covered. So that means that there's been sufficient pre-sales to cover the bank finance. We have a fixed price building contract. We have all the building permits in place. So the project is significantly de-risked from the other phases. So let's move on to the project or the property. What I have here is just some headline numbers in terms of the metrics. The property is at Spencer Street, West Melbourne. I'll talk about the location in the next couple of slides, but these are the key metrics which are important to us. The gross revenue is 56 million, the net revenue after GST and settlement costs 49, total development costs 42, which gives us a loan to cost ratio of 68.5%, and a profit of 7.3. Now that profit number is a pretty important number. And when we do our feasibilities, we do them on what's called a fully loaded basis. So we put contingencies in there for construction, for consultants. We also base it on a project timetable of about 6 months beyond what the bank and the developer actually believe the project will go. Again, just to try and put some fat into the numbers in case we need to call on that margin. Comes back to one of the exit considerations that we're always mindful of. So that profit figure of 7.3, that represents an interest cover to the investors of around 2.5 times. So that 7.3 is net of the principal that we put into the project. So that means that's the figure that we get our interest back, not the principal. So we're in a pretty healthy stage in terms of the financial metrics. Financial metrics, however, being an old risk guy, isn't the driver of why you get into a transaction, but it's obviously a key criteria in the consideration. Okay, so the next slide, the property development itself. So it's located in Spencer Street, West Melbourne. That is what we refer to as a fringe CBD suburb. So it sits about 2.5 kilometres from the centre of Melbourne. And it's an area that I actually prefer to operate in. I prefer the distance. I prefer that fringe area from about 2-3 kilometres out of CBD to about 10 kilometres out of CBD. And that's for the most part because Melbourne CBD is a huge driver of demographic activity. It's the biggest. We have 1 million people work in the city on a 9 to 5, Monday to Friday basis, have access to entertainment, health, education, sport, transport, infrastructure. So it's a pretty big driver of demographic activity. So for me, that's what I think stimulates demand and why I'm interested in playing in that space. At the end of the day, I'm only interested in getting involved in those developments where we know there's a good marketability for that product because our exit, again, relies on these apartments selling. So yes, it's in a good location. Transport straight out in front. There's tram straight out in front of the building. 105 apartments, 15 levels, 74 car parks. It's currently, in terms of construction, it is. We've completed the basement, so it's a 3-level basement. So completed the excavation, and they're now out of the ground. Again, from a de-risking perspective, coming in at this particular stage, from a construction risk perspective, that has been significantly mitigated because a big chunk of construction risk is actually the unknown of what is actually under the ground. And if you strike rock or soft spots or any of those sorts of issues, you can suddenly escalate your construction costs. So we're in a good position. We're out of the ground, and that, from an investor's perspective, is a milestone event. The investment opportunity today for investor crowd investors. So we're looking for the last top up of capital before the bank comes in and funds the rest of the project. We're looking for 3.8 million. Most of that's gone. However, we've got to put aside units for investor crowd investors. So we're looking forward to the opportunity of partnering with investor crowd and investor crowd investors to fund this last stage of development. The anticipated term is, we're saying 12 months, but we believe it will be completed by October 2017. However, the run rate that the project's on at the moment would suggest that it's more likely to be July, August. So the builder and developer, they've done 10 projects together up to this one. We've participated in 8, and every one of their projects has been completed ahead of time. So I've no reason to believe that this won't be ahead of time. It's already 8 weeks ahead of time. Assuming the rest of the construction goes well, we'll be exiting before 12 months. Given that this investment is 1.5% per calendar month, which is 19.56% per annum, the minimum is 10 months interest. So we structure these investments with the developer that it's got to be a minimum interest period. Otherwise, it's too easy for them to put our money in and then they can refinance us out. So there's got to be a cost to finishing early to refinance us out. Interest is capitalised and paid monthly in arrears, which means that you just calculate the interest monthly, but you don't get paid the interest back until the end of the project. There's no guarantee of capital return. The return is net of all costs and fees. and for offshore investors, there's a 10% withholding tax applicable. And the tax situation for this type of investment, it's a fixed income security, which under the taxation laws in Australia means that we only need to withhold 10% to pay the local tax. There's no requirement for you to lodge local tax returns in Australia. So this is a straight interest payment back to the investor. Okay, moving on. Okay, oops, guys, sorry about the dots, the pictures up there on the top of the screen. That's an editing error. So developer background, again, a key component of this transaction is the developer and the builder. They're the ones that are going to operationalise and make this investment happen for us. This is our 8th transaction with these two parties. Every one of them we've successfully investors in and invested out, and in fact all of them have come out early. So we're on a pretty good, we've got a pretty good track record with these particular guys. They've been approved by all the 4 major banks in Australia, both the developer and the builder. That is not an insignificant achievement. It's very, very difficult to get construction finance, $30 million of construction finance in this instance, in Australia at the moment. So getting the bank approval for both those particular parties is a significant milestone and a credit to them, obviously. So Alpha 14 is the developer and ImageBuild is the builder, and they've got a good track record, and they've, in terms of development they've done together and development that they've done with us. So I absolutely recommend them as a partner for us in this transaction. Okay, key benefits for this transaction. So I'll probably just call out a couple of them. In terms of the first I'll talk about is probably the experienced team, and it's a team effort to get a development done. And we as the capital managers and investors, we're just part of that team. When things go wrong, and if things go wrong, it's absolutely critical that you've got the right people around the table to deal with these types of issues. So we've got a developer we've got track record with, experience. We have a builder that's got track record and experience, ourselves, and in my team there's, sadly, it's close to 150 years of banking experience in the development space. And we only partner with the banks, the 4 major banks. We don't partner with the second or third tier transactions. So if an event occurs, requires us to circle wagon trains to deal with the problems, we've got the right people to deal with it. Exit strategies, I talk about exit a lot. It's important to me, not just because I have my money in it, but it's a key component of our risk culture and considerations getting involved and recommending to investors to get involved. Key components there is step-in rights. So in addition to our lending documents, our loan documents, our mortgage documents, our caveats that we have with the developer, we also take a minority shareholding in the development itself. That's through an indirect ownership that I've touched on before. And in there, we've got a shareholder agreement with the developer which prevents him from doing certain things that are detrimental to our interests. So he can't sell the property, he can't dilute our interest, he can't take on debt, he can't do related party transactions, all those things that could potentially affect the margin and the profit at the end of the project, which is obviously it's part of our exit. If he does breach any of those covenants, we have what's called step-in rights, where we can actually take over the management of the property, of the development. And I've got the team of people around me that can manage this project out. And again, number one consideration is getting to the finish line, getting our investors' money out, and reloading for the next transaction. So it's an important control, and it sits above a lot of the mitigation strategies we have around it. The stage of the project, I think, is a standout benefit for the investors. Coming in at the end of the tail of the project, if you recall that slide, the construction finance has been approved. We have a fixed price contract, so we know what the biggest single cost line of the project is going to be. That contract, by the way, is vetted by independent quantity surveyor. In this case, it's WT Partners, which is an international quantity surveying firm. to confirm that the contract is obviously bona fide, valid and achievable. And we have the pre-sale debt cover, so there's sufficient pre-sales over the project to cover the bank debt. In this stage, that's definitely a key benefit from I talk about governance and oversight. These are important things, because if I talk about risks and exits, but that only makes sense if you actually have your finger on the pulse of things. So we manage a project. We're involved in weekly meetings with the developer and the builder, and the monthly meetings with the bank. So we very much have a finger on the pulse of the project. We send out monthly updates to the investors, and we give them lots of pictures, videos, and so they can see the progress. So it's very much, we try to engage so everyone has visibility. We have a priority ranking ahead of the sponsor. We get paid after the bank. We have a debt instrument in terms of an unregistered second mortgage. We will lodge a caveat after the bank facility has been set. So we're covered in terms of if we need to protect ourselves on either debt or equity scenarios. We've got those options. The next slide. As all investors are always interested in what the risks are, and so they should be. For me, there's plenty of risks, and risks are about understanding the percentage of likelihood of that particular event occurring. And understanding the risk is probably, in all seriousness, about 80% of mitigating the risk. Key risks, people ask me what is probably the key risks at this particular stage of the project, because they've changed. I would talk about construction risk, although we've just moved probably to a much lower level of risk with construction risk now that we're out of the ground. We've completed the excavation. So in terms of what happens subterranean is less of a concern for us, because that could blow out construction costs. So we've moved past that. Probably the other risk is pre-sale contracts not proceeding. We refer to that as market risk. In this particular, in Australia, in Melbourne, in this particular market risk in terms of pre-sales not completing is around 3%. So 105 apartments, then you can, on average, expect 3 of those will not complete. Now, from our perspective, we only need about 50, 55 pre-sales to pay out the bank. The remaining 45 pre-sales or contracts are ours. Once the bank's paid out, title comes to us. So any pre-sales that fall over, I've got very little concern, because I'll march those titles to the bank, get a loan against them. That loan and mortgage becomes the developer's problem. I get the money, and we, the investors, get our money and move on to the next transaction. So once the bank's paid out, we're very much in the box seat. And at the moment, the pre-sale debt cover for the bank is about 50% higher than the bank debt. So we're in a pretty good position in terms of market risk. That being said, forecasts, indications, trends, it certainly doesn't look like there's going to be any behavioural changes in the market in terms of pre-sales falling over. So we're not getting any signals that this is an issue in this particular market. Project overruns, construction delays, they're similar types of risks. So they're talking about if there are events occur during the construction that's outside the building contract that crop up. They do happen. Typically not at this level, at large developments. They typically happen in smaller developments where they don't actually have good estimators in terms of building contracts together. That being said, as a risk, how do we mitigate that? There's a contingency in the construction. The construction loan is 29.7 million, 30 million. So 5% of that is put aside at the beginning by the bank, which is 1.5 million, to cover any project overruns and a contingency. So there's a bucket of money, and that's included in the total development cost of the project. So if that contingency is not used, it obviously drops back to the profit of the project. It's probably also fair to recognise that Alpha 14 and Image Build, the developer and builder, they've done 10 projects together, and they've not used $1 single of contingency over those projects. So hopefully that will be a trend that will continue, because again, anything that drops down to the profit line and improves the margin is a good outcome for us. So I might just leave it there and hand it back to you, William. I know I've just skimmed over things, but if there's any questions that's come through that you'd like me to just drill down a little bit deeper, I'll gladly respond.
Great, thanks, Kevin. It's very insightful. We do have a couple of questions, but for any participants today that have further questions, you can email me directly at william@investorcrowd.com, and we'll be right back with you. You mentioned the pre-sales horizons that we need to meet for the senior and the mezzanine debt. What is the current state of pre-sales?
Yep, no worries, William. At the moment, they're sitting at 68 qualified pre-sales. So a qualified pre-sale, just so we're all clear, is where it's a bona fide contract, 10% of the purchase price is held by the solicitors in the solicitor's trust account, and it's an arm's length contract. So there could be other contracts on top of that that might have 5% deposit, which obviously still make them a bona fide contract. But a qualified contract rather. So in terms of actually holding the deposit. So yeah, 68, which I think represents about 40 million, might be 41, $42 million of sales. Someone will come back to me and say that number's not right.
Okay, that's great. So the marketing of the units has gone well, and from what I understand from some of our conversations, one of the reasons you like similar projects is the price point between 450,000 and 650,000 is very digestible in today's market. So I obviously the amount of sales preceding development is an indication of that. We do have a question about the senior position. Which bank has a senior position?
National Stable.
Okay, NAB, great. And could you just explain why the second mortgage is unregistered? We do understand the security that's behind that, but what's the process where it remains unregistered?
Yeah, sure. So it's because it's a construction loan, banks have an aversion to granting a deed of priority for registering a second mortgage. And that's basically because a construction loan is effectively a line of credit. They approve a particular amount, but it's not drawn until, obviously, and it's not drawn until you actually go through the particular development. They have an aversion because they don't want to cap what they could potentially claim if something goes wrong. So we negotiate and we say, okay, we'll have an unregistered second mortgage, which means if something does go wrong, I could walk to the land titles office, which is 2 blocks from my office, and register that mortgage. So we immediately sit on top of the bank. So it's there as a precaution if something goes wrong, and that's the only reason we don't lodge it, because one, the bank has an aversion to it, and if I push the issue with them, what normally happens is they change the whole pricing of the transaction, and that's not necessarily in our best interest either.
Okay, thank you. I think we have time for one more question. This is something that we get asked quite a lot at InvestorCrowd. Currently, the market in Melbourne, developers are paying quite high interest for first or second loans to the development projects. Could you just briefly explain what's caused this situation?
Yeah, sure. So the debt at the moment in Australia and pretty much around the world is very, very cheap. So you can get debt, construction loan debt at 5%. The developers on these projects are making something in the vicinity of 50 to 70% ROE. So paying away mezzanine funding at 20 to 25% is still much cheaper than them using their own equity. So they can get a much better ROE by topping up the debt level, and that's a great opportunity for we in terms of mezz investors to participate. But it's also a two-pronged. The banks have also reduced how much they will lend into projects. So they've gone from 80% loan to cost ratio down to 70%, which has just opened up an opportunity for we MES lenders and we MES investors to participate. But the developers can afford to pay it because their ROE is still twice as high as what they're going to be paying in debt.
Okay, thank you. That's about all we have time for. We try to keep these under 30 minutes, and we're right at 30 minutes. So Kevin, once again, thank you so much for your time. To our members listening, please don't hesitate to contact me directly again, william@investorcrowd.com. And we look forward to hearing from you all later. Kevin, thank you again.
Thanks, William. Thanks.